The U.S. stock market is currently closed as it is Sunday, November 9th, 2025. We are looking at the critical closing data from the last trading session, Friday, November 7th, 2025, for Plug Power, ticker symbol PLUG. The stock finished the session at $2.65 per share. This was a significant move, a gain of 14 cents or 5.58% on the day. That Friday session was a volatile one, with the stock opening at $2.38, hitting a low of $2.35, and surging to a high of $2.70 before settling at that $2.65 close. The volume was massive, with over 116 million shares changing hands. Now, the immediate expectation when you see a 5.58% pop on heavy volume is clear optimism. The assumption is that good news has hit or that a new uptrend is firmly in place. But the reality is far more complicated and, frankly, far more tense. That 5.58% jump wasn't a victory lap. It was the sound of a casino floor placing its final bets. This entire move is predicated on one single event: Plug Power's third quarter 2025 earnings report, which is scheduled to drop tomorrow, Monday, November 10th, after the market closes. That 116 million shares in volume wasn't conviction. It was a massive, polarized bet on what those numbers will say, with bulls loading up and shorts likely covering or digging in. The common belief, the one that has drawn so many people into this stock, is that Plug Power is the key to the green hydrogen future. The narrative is powerful. This company provides hydrogen fuel cell systems, electrolyzers to create the hydrogen, and the infrastructure to support it. They have deals with giants like Amazon and Walmart. The stock has seen an incredible surge in the last 6 months, running up more than 200% from its 52-week low of just 69 cents. This is the story everyone wants to believe. It has the same world-changing feel that attracted early investors to Tesla stock. Many who are doing their self-investing look at this and see a ground floor opportunity. But the expectation of a smooth ride to a green future is crashing headfirst into a brutal financial reality. While the 6-month chart looks explosive, the 1-month chart tells a story of extreme nervousness, with the stock down over 21% in that period. This isn't the steady climb of an Apple stock or the dominant profit-driven ascent of Nvidia stock. This is the chart of a high-stakes gamble, and tomorrow is the day the cards are turned over. The reality check begins when you look at who is trading this. Plug Power has become a battlefield stock. On one side, you have a massive retail investor base, a full 56% of the company's ownership, who are trading this on platforms like the Robinhood app or using SoFi Invest. They are driven by the narrative, the long-term vision, and the massive short interest which they hope to squeeze. On the other side, you have the institutions, who only account for about 38% of the ownership, a very low number for a company of this size. Many of these larger players, using sophisticated tools on interactive brokers, are betting against it, shorting the stock based on its fundamentals. This isn't an investment you make through Fidelity Wealth Management or something you'd find in Schwab Intelligent Portfolios. This is a high-risk, high-reward play in an individual brokerage account. The division on Wall Street is stark. Analysts are completely split. While TD Cowen recently raised its price target to $4.50, the consensus rating is a firm hold. This isn't a buy or strong buy. A hold rating from 47% of analysts, with another 27% rating it a sell or strong sell, is Wall Street's polite way of saying they have no confidence in the company's financial footing. The average price target is a messy spray, with some as low as 75 cents and others as high as $7. This is the definition of a stock with no clear consensus. So, let's talk about tomorrow. The expectation for Q3 earnings is a loss of 13 cents per share on revenue of about $170 to $176 million. The problem: Plug Power has a long, painful history of missing these estimates. They have missed earnings expectations in each of the last 4 quarters. The market is expecting a loss, But what it cannot tolerate is a loss that is worse than expected or a revenue number that signals a slowdown. But the earnings per share number isn't even the main story. The only number that truly matters for Plug Power tomorrow is cash burn. This is the company's single greatest risk. In the second quarter, Plug Power burned through $230 million in cash. Let me repeat that. In one single quarter, $230 million vanished. This is while the company is reporting horrifically bad gross profit margins, which were at negative 66.5% in recent quarters. This means for every dollar of product they sell, they are spending significantly more than that just to produce it, even before administrative or research costs. This is not a sustainable business model. It's a ticking clock. The company is in a race to scale up its new green hydrogen production plants, like the one in Georgia, hoping to drastically lower its costs before it runs out of cash entirely. This is why the recent corporate actions are so concerning to seasoned investors. Back in July, shareholders approved a measure to allow a reverse stock split at a ratio anywhere from 1-for-5 to 1-for-200. This is a classic move companies use to get a low-price stock back above the $1 minimum requirement to stay listed on the Nasdaq. It's a financial maneuver that does nothing to fix the underlying business and is almost always seen as a negative sign. This is the financial reality that contrasts so sharply with the green hydrogen dream. The expectation is a clean energy future, but the reality is a balance sheet that is on life support. The entire business model and that of the entire U.S. hydrogen sector is precariously balanced on government support. The Inflation Reduction Act's 45V tax credits are essential for Plug's model to ever work. Any delays, unfavorable rules, or political changes to those credits could be a fatal blow. This adds a layer of political risk that you simply don't have with other major tech or industrial companies. The recent trading has been frantic. That 116 million share volume day on Friday shows the desperation for a definitive move. Traders using Fidelity's platforms or the Fidelity mobile app are trying to position themselves. Those using Robinhood stock trading see the high short interest and are dreaming of a short squeeze. But the institutional side, the one that looks at the cash burn and the negative margins, sees a company that is fundamentally broken until it can prove, with hard numbers, that it can stop the bleeding. This is the ultimate test of online investing. Do you bet on the story or do you bet on the numbers? With a company like Plug Power, the two could not be more different. This isn't about finding the best investing sites or the cheapest investment help. It's about deciding if you believe the company can survive long enough for its story to come true. This is the kind of stock that makes a SoFi robo-advisor look like the safest bet in the world, as it's the exact opposite of a diversified, stable approach. So, what are the possible scenarios for tomorrow's report? The bull case is that Plug Power finally delivers. They meet or miraculously beat the minus 13-cent EPS estimate. They show revenue growth, but most importantly, they announce that cash burn has significantly slowed. They give strong, confident guidance for Q4 in 2026, assuring investors their new green hydrogen plants are ramping up and the path to profitability is clear. If this happens, with the high short interest, this stock could explode. It would squeeze the shorts and could easily gap up, challenging its recent highs. The bear case, however, is far more likely, given the company's history. They miss on EPS, perhaps badly. They miss on revenue, showing a slowdown. And the fatal blow, cash burn, remains at or above $200 million. They guide down for Q4, blaming project delays or the cost of hydrogen. If this happens, that 5.58% gain from Friday will evaporate in an instant. The stock will crash, and that 52-week low of 69 cents will suddenly look like a very real and very terrifying possibility. This would confirm all the fears of the institutional sellers and validate the sell ratings. This is the ultimate expectation versus reality setup. The expectation, held by 56% of the retail owners, is that they are holding the next Tesla stock, a company that will change the world. The reality, held by the majority of Wall Street, is that they are holding a company with a potentially fatal cash flow problem that has yet to prove it has a viable business. Tomorrow's earnings call is the moment of truth. Do you trade this volatility on Interactive Brokers, or do you manage your risk with Fidelity Mutual Funds or Fidelity ETFs? This is a question every investor has to ask. What are you expecting from Plug Power's earnings call tomorrow? A beat or another big miss? Comment below.